So now we're going to move on to Chapter 4. And Chapter 4 deals with completing the accounting cycle. So now we have the opportunity to understand that we are solely in the reporting phase now. We are ready to roll with reporting that information. Again, I want to keep reminding you guys that accounting is important for people because of the mere fact is that it records information and it generates it in the reports for people to make decisions. People being everyone in the economy who relies on this business in some sort of way. Okay? And so how do we rely on the business? By reading those financial statements. So understand the connection at this level of how important recording is. Recording is very important because whatever you record belongs on the report. So if you're recording incorrectly, the report will be incorrect. And of course, people will be able to make incorrect decisions off of that incorrect information. And so now we've just finished worried about adjusting. That was a major step in the process. So now that we've finished talking about adjusting, we went over the adjusted trial balance. The next step after the adjusted trial balance is to make the financial reporting, make those financial statements. And so that's pretty much where we're going from here, is that we're going to make financial statements. Now, the textbook talks about a workbook. I'm not going to spend a lot of time in the workbook, guys. I'm not going to even actually really talk about it in a particular form of this video. But I will let you know that the workbook is just a device to keep everything systematic from the beginning of the accounting cycle, per se, to the end of the accounting cycle in terms of your financial statements, okay? And that's pretty much done in Excel or whatnot. And it's very beneficial to a lot of accountants. But that's pretty much all that I want to kind of address on that issue. More importantly, you should know that after the adjusting process, it's time to do the financial statements. We went over how to do financial statements, and you should be practicing diligently how to make those financial statements from your adjusted trial balance. Okay? We already talked about the relationships of the financial statements, being that you start with the income statement. That income is transferred directly to the statement of retained earnings because retained earnings in itself is income. And once you've calculated the changes in income or retained earnings based on the net income, net loss, and the dividends, you then calculate an ending retained earning balance that from the statement of retained earnings should be transferred into your balance sheet. We also talked about, honestly, this is really a review. Even though Chapter 4 is new, it's relatively reviewing everything that I've already discussed. So we're real casual right now. But it talked about how to separate your assets. We already know that we separate our assets in order of its liquidity. Liquidity being how easy it can convert to cash. We already said that our assets are always broken down into two categories. We have current assets, we have long-term assets or non-current assets. Current assets are all those assets that convert into cash less than a year. Long-term assets are those assets that you keep longer than a year, right? And we know the examples of the current assets, and we pretty much know the order by now, if you've been practicing homework, in which you should list your current assets. Always start off with cash, normally go to the accounts receivable, inventory. You can talk about your prepaids, things of that nature, right? All those supplies, all those are considered current assets, right? Long-term assets, that's your land, equipment, furniture, yada, yada, yada. Okay? What I really want to talk about, honestly, is closing process, the closing process. So right after you generated your financial statements, the very next step of this particular process is to close. You're going to have certain accounts that need to close. And when we say close, we mean that certain particular account needs to start off fresh for the new year. Be in the next year, be in the next quarter, be in the next cycle. Certain accounts have to start off fresh with a zero balance. That's what the closing process does. It closes out certain accounts that have a zero balance. So we have temporary accounts and we have permanent accounts. Obviously, by the name, temporary being that it's not going to be here for an indefinite amount of time. It's going to be there for a definite amount of time and it needs to close out. So temporary accounts are all those accounts that need to close out to zero at the end of the accounting cycle. Okay? So what are temporary accounts? Temporary accounts are revenues, expenses, and dividends. Temporary accounts, revenues, expenses, and dividends. Those are your only accounts that you're going to touch to close them out to a zero balance. Okay? Now, why should you do that? Because revenues measure income. Dividends affect retained earnings. And, of course, expenses have an effect in measuring income as well. Revenues minus expenses give us our income, and dividends affect retained earnings. All these particular accounts are measured in a period sense. And so we need to start off fresh for the next year so that we don't report revenues from previous years or expenses. So that's why they always have to have a zero balance, okay? And so I'm going to go over the steps in which you have to do to close out accounts, these temporary accounts. What are permanent accounts? Accounts that you never close out, obviously. And they're all the other accounts in the world besides these three types. So everything else besides these three types you won't touch. These are the only ones that you touch. So step one, when we're talking about closing out accounts, closing process. Step one of the closing process, you're going to close revenue accounts, to income summary. So what are revenue accounts? We already know we provide a service, we sell a product. Income summary is just an account that you pull out the wazoo, really, and that particular account is going to close itself out in this process. So don't make a big deal about income summary. It's used for closing out certain accounts. So revenues have a normal balance of a credit because that's the side that revenues increase on. And so in order to ever close out a revenue, you have to do the opposite of increasing it. You have to decrease it to a balance of zero. And so how do you close out revenues? Through a debit, obviously. So to close out revenues, you're going to debit all the revenues for whatever the amount is that's in the ledger. And you're going to credit income summary. Why? Because that's the rule. Close it to income summary. Very easy. So if it's a sales revenue, then you would debit sales revenue. If it's service revenue, any revenue you have, you got to close it out by debiting it. Okay? Now, what are you going to credit? Income summary. Step two, close all expenses to income summary. So what do I mean by close all expenses to income summary? Basically what I'm saying is that we have several expense accounts. Each one of those, each one of those expense accounts need to be closed out individually to have a zero balance. How do you increase expenses? Through a debit. So to close them out, you have to do the opposite, which is a what? Credit. So what do you guys think we're going to debit in terms of closing out expenses? Obviously, income summary. So you debit income summary. For whatever amount it is, whatever the amount it is of the total expenses. And I'm going to write the word each expense because it's letting you know each expense needs to be closed out. All right? So whatever each expense is, it needs to be closed out. Okay? Your next step. This is obviously, guys, your template that you can use to understand how the process should look. Now, your next step deals with transferring income or loss for the period into retained earnings. Remember, we said from a reporting standpoint that we take that net income from the income statement and transfer it into our statement of retained earnings to increase it if it's net income or to decrease it if it's net loss. That's what we've been trained to do. But we have to also do the same thing on our journal, in our books. So what we're doing now is we're taking that income or that loss and we're transferring it into retained earnings. What are the rules? Incomes do what to retained earnings? Increase it. Losses do what to retained earnings? Decrease it. So basically what you're going to do is you're going to identify if you have an income or a loss. How would you do it? Taking your revenues, subtracted from your expenses. And whatever that income or loss is, it needs to be transferred into retained earnings. So step 3 tells us to transfer income / loss into retained earnings. Now, the journal entry will be one of two of the following that I will give you. If you have an income, obviously we know our expenses were lower than our revenues. We know that our revenues exceeded our expenses in order to have an income. If we have an income, then we have to increase retained earnings. How do you increase retained earnings? It's a part of stockholders' equity. It's in the clear group, so you have to credit it. So in order to increase retained earnings, if you have an income, you should debit income summary for an amount, whatever the income is, and you should credit retained earnings. Again, why are you crediting retained earnings? Because it's increasing. How do you know it's increasing? Because my revenues exceeded my expenses for the period. That's how I know it's increasing. So that's how it would look if we had an income. But how would it look if we had a loss? What if we had a loss instead of an income? What is a loss? How do you know if you have a loss? Your expenses for the period would exceed your revenues. How do losses affect retained earnings? They decrease them. So if we're trying to decrease retained earnings, would we debit or credit it? We would debit it. So if we have a loss, we have to debit retained earnings. For the loss. And what do you guys think we're going to credit? Income summary. And there, right there, is the example of how income summary just cleans itself up. Income summary is basically going to close itself out. Income summary, after the third step, should no longer exist on the books anymore. So that's why I wouldn't make a big deal trying to really understand what income summary is there for. We use it as a purpose to close out accounts. Okay? So remember, if you have a loss, this is the journal entry you're going to use. If you have an income, this is the journal entry. And last but not least, so far we've closed out our revenues. We closed out our expenses. Now the last set that we're going to close out are the dividends. The dividends. And so the next step would be to close dividends into, what account you think, guys? What account affects dividends? Retained earnings. Very good. Close dividends into retained earnings. All right? Dividends has a debit balance. So to close out dividends, we have to credit it. So whatever amount of dividends you have on the ledger, you need to credit it. And we know that retained earnings does what to dividends? Well, I'm sorry. Dividends does what to retained earnings? It decreases it. So how do you decrease retained earnings? Through a debit. So you will always debit retained earnings for an amount. And you will always credit dividends for the amount that was given. Okay? So this pretty much, guys, summarizes chapter 4 in its best of its essence. It's not a lot going on in chapter 4, so we're not going to spend a lot of time in chapter 4. So chapter 4 summarizes the process, kind of closing it all out. After we have the adjustments, we make our financial statements. After we make the financial statements, we close out these accounts. There's one more step to finalize this accounting cycle, and I'm going to just really talk about it real quickly, but it's to make another trial balance. Yes, another trial balance. And the last trial balance is called the post-closing trial balance. I'm not a big stickler for post-closing trial balances because it's really redundant. But basically, it's going to be a trial balance minus your temporary accounts. Okay? Good chapter. Very light in scope. So hopefully you guys are able to get on with everything and understand what we're doing at this level so far.